Good morning, everybody. Good morning, everybody. It's a pleasure to be back, and it's already week 3 of a lecture series on corporate law and regulation. This is the lecture which is less interactive than the workshops. This week we will see 2 workshops. One regular workshop on the topic of this week, and then at 5 o'clock on Thursday a collective workshop. Let's see how that works out on the topic of week 2. And today we will reach a conclusion, an interim conclusion on the first 5 aspects of corporate law as identified in the Anatomy of Corporate Law, the mandatory textbook. And we will start with the first topic, assets and finance, of the additional 4 aspects of corporate law as introduced in the previous 2 weeks. So today, to be more concrete and accurate, the limited liability and the transferability of shares, and connected to the transferability of shares topic of today, we will discuss chapter 7, the prescribed chapter of this week, and that is dealing, page 171 and further, with fundamental changes. And we zoom in on the merger as a sort of cousin transaction of transferability of shares. We will zoom in on mergers, so the combination of 2 entities. And the reason that we do so is that let's say 100% of your companies of choice of the midterm assessment are the product, the result of a merger somewhere in history. And the corporate news in newspapers is quite often dominated by disputes and deliberations and issues around mergers and acquisitions, and most recently around Dutch multinational corporations like Akzo Nobel, the proud sponsor of a large sailing vessel participating in the Volvo Ocean Race. I hope you all follow that, with the final destination in The Hague in 2019. But the second reason is that the information you read and absorb as part of your paper, midterm assessment, is geared towards potential merger, interested parties, etc. So that is sort of color. And the third reason is that we will devote a whole week, week 6, on that mechanism of mergers and acquisitions. And then the fourth reason is that within such a topic as mergers and acquisition, all the other topics present themselves as very relevant. So that is why we embrace that as one of the key topics of this course, next to corporate social responsibility. Well, what are we discussing? The legal personality, or legal personhood as the first. The second we introduced as the shareholder ownership or investor ownership, so someone that owns the legal person. And please be reminded that could be a corporation, and this is where the tree comes in. Thirdly, the delegated management. So half of you indicated in the little questionnaire in the workshop lecture or workshop that you might end up as manager. So the manager chair, this is a director chair of movies, as symbol, as icon, that is you. And then fourthly, the limited liability we will discuss today, and the transferability of shares. And just to remind you, what are the other 4 additional aspects? Assets and finance, personnel and innovation, production and sales, and regulation and compliance. Today, limited liability what is the concept? What are the main legal rules? We discuss some examples, and in the workshop we will deal with case problems. Well, here we see a large vessel that breaks or has broken into two parts, and they have the unreasonable habit to do that in the middle of the ocean, and then all kinds of goods that are transported, for instance oil, spills into the ocean, and there we have a lot of damage to the vessel, damage to persons running the vessel, so sailors who drown, the cleaning up of the ocean and other externalities in terms of the environment. And then the key question is, in tort, who has to pay that damage? And then there are two options. This is plain tort law. You have been there partly with colleague and room office mate Michael Milo. Two options in tort law. One is that the damaged party pays the damage, him or herself or itself, and the other option in tort law is that someone else pays the damage. And linguistically, if someone else pays the damage, that is then damages. So with the S, that is the phenomena linguistically. So if you have to pay damages, then you have to pay the damage of someone else. A little subtle thing in the English language. Well, and obviously, no surprise, if someone else is by law obliged to pay the damage of someone else, or is obliged to pay damages, then we have criteria, and traditionally there are 3, 4, or 5 main criteria on the basis of which such a third person has to pay, has a non-contractual liability to pay damages, and those 5 criteria are that there should be a unlawful act or omission. That is the action of a certain person that is contributable to the tortfeasor, so the person who commits the tort, the unlawful act is also called tortfeasor. The second key ingredient is that there should be damage. So lawyers have these sort of lists of criteria that are of a high no-brainer nature, but to express a sort of lawyer-like language, then you hit all those 5 topics one by one, and that is typically how lawyers approach it. So this is not rocket science, as that you are now surprised based on your face muscular situation. And the third thing is that there should be a causal link between the act and the damage. For instance, the act or omission is not to conduct regular maintenance on a vessel. Then the damage is that it is broken in two. And then the causal link is that because of no maintenance, the vessel is broken in two. And so that is the simplistic way you have to think. And we apply this thinking to corporate law in a minute. So this is to understand the liability part. And then the fourth key ingredient and criteria is the attribution. If there is a single company responsible for the maintenance of the vessel, with all in contract stating you should maintain my vessel, and then the attribution to that actor is very simple. But in most cases there is a very long chain, very long causal chain, meaning that one party is obliged to maintain the vessel based on the contract in terms of managing the maintenance. Then that party subcontracts a painter and a welder and an inspector and all kinds of other parties, up to and including the supplier of a little metal ring. If we put this story in a sort of plane context, an airplane, then quite often they crash because of a little metal ring that is not on the spot where it is supposed to be. And then the key question is, if that is a, for instance, personal error of a maintenance guy with a salary level, let's say $20,000 a year, so that is 1/5 of your first salary. If his omission or wrongful act is this metal ring not in the correct place, is then the complete damage attributable to that single individual? And that is then a key question in legal brains. And then please be aware, and then I come to you, that scientifically a causal link is endless. So in natural science they have discovered that if a butterfly in China flaps wings, then a hurricane in the Caribbean is the causal link. And so from a scientific perspective there is no end to causal link. Because why is that engineer not putting the metal ring on the right spot? Well, because his education in metal ring placing school was faulty, and he was on that faulty school because his parents were not taking care of him, and that was because of the municipality was not providing proper housing to that family, and so forth and so forth. And then lawyers are, and the legal field is very capable of drawing a line and say, based on reasonableness, based on fairness and sort of choice method, they say, well, here it stops the causal link and the attribution to the actor. And we will see that with directors in a minute. Your question?
Yeah, maybe premature, however. How does it relate to the shareholder/limited liability cases?
Yes. Well, where the topic is limited liability, then the limitation is to this liability. So first you have to understand what is liability, and then the next step is, as a shareholder or manager, what is then the limitation of this? And limitation means that you're not liable. But if there's no liability in the first place, then there is also no need to discuss limitation of that liability. So that's the relationship.
But I can imagine that there are severe consequences by corporations not acting liable, and the consequences severe, as I said. There is some aspect to it that there is a liability to someone somewhere that causal relation is affected.
Yeah. And so now that we feel the threat of the liability, of the legal obligation to pay damages, it motivates us to inquire and map where or which individual shareholder manager is not or is liable, and if not, who is then liable. And if nobody is liable by law, then we have option one, then the person suffering the damage should bear the damage him or herself. So that's exactly the key thing. Well, then liability of a corporation needs one additional mental step, because we figured out last week, where we discussed the legal personhood concept of a corporation, that a corporation is nothing more than a piece of paper. And pieces of paper are unable to wreck vessels. So we need human beings on behalf of the corporation to act, and then if we have the delegated management and employees that act, then such an act could be unlawful or tortious or resulting in non-contractual liability. All synonyms for the bottom line statement that the corporation has to pay. What? Damages. Well, and which two acts can be attributed to the corporation, to the piece of paper? And that is the act or omission of the board, so the formal representative of the corporation. But the theme are large multinational public corporations listed on stock markets, and we have all this stereotype board member picture in our heads. They are driven around with chauffeurs and suits, and so they are rather remote from the maintenance of vessels. And how does it work? The second group, all the 100,000 plus employees of the corporation. And there we see a similar attribution from the employee's action to the corporation. So the beauty of being an employee is that you are acting on behalf of that larger corporation. You are, in that sense, an extended person from the board. And the same attribution mechanism that applies to the board applies to the employees. And the difference between board members and employees is that board members are registered in the company register. We will discuss in week 5, a little technicality. So they are an official organ of the corporation, and employees are not registered. That's the corporate law distinction between the two. Where it comes to non-contractual liability, tort law, then they share the same distinction. And then there's a third category, others, who might act, and there you have to think of two subcategories. One is subcontractors, so another corporation that is involved in the maintenance as if they are employees, but technically based on labor law they are not employees because they are in Dutch ZZP'ers or other subcontractors. But then, based on legal arrangements we will discuss, such an act is attributed to the corporation, for instance, owning the vessel. And the second rare category, hidden in the others, is the infamous shareholder misbehaving as a board member / employee. What we discussed last week on shareholders was that they are with 3 main rights on the Bahamas. They are not anywhere near the vessel in the stereotype setting. So they have the appointment right and dismissal right of board members, the decision on the look and feel of the financial statements, and receiving dividend. That's all. But they can change color. They can ultimately enter the war and run around, and then all of a sudden they have a role mixture, and then they might end up doing certain actions that leads to the liability of the corporation. But that is the rare, extreme rare situation. So focus on board and employee. And then, what is then the limitation of the liability? Well, there we start with the shareholders. The investor owner, also known as shareholder, stereotype on the Bahamas, investing money, but that's their only involvement. They are not liable. How come? Well, because each and every jurisdiction has a rule that states shareholders are not liable. And there's a very simple logic to this. If you are a Bahama investor owner, you know, beach chair, cocktail, then You don't like liability because you're not even involved. You don't know that how many ships there are in your company. Well, you can read it in your annual report, but the only part you read is the level of dividend equals to internal return on investment. So you could explain this in different ways, and the book does so. And let's start with the bottom line simplistic explanation. There are no shareholders on the globe interested in being an investor owner if they are liable. So in a capitalistic system, this is a sort of key legal rule that facilitates the individuals, could be corporations, to invest their excess cash into other enterprises. And that's the whole philosophy of capitalism, with savings and then investing savings in other projects and then getting the ball rolling. So that is step one. And that is 95% undisputed, because they don't have dirty hands in the first place, so why bother making them liable? The second group is much more dynamic, the board. The board has as starting point the same rule that they are not liable. With the same simplistic reasoning, if you finish your economics degree and a master and who knows, an RA and all kinds of other degrees, and you have $200,000 study debt, and you land your first job as a board member, and then you extremely dislike the whole idea that when you make a decision appointing a maintenance company of your vessel, if you end up in Rotterdam, that the next day you get a call by a widow of a sailor who says, well, by the way, my husband drowned, and now I miss my annual income. Can you pay that personally? That would not be sort of the story you would like to tell on your first Christmas dinner in that calendar year. And so the whole idea that facilitates the smooth investment of excess cash applies to managers. We all would not like to be appointed as official board member if there would be personal liability involved. Personal liability means that your own car, color TV and house is put up to auction and you end up under the bridge. Okay. Then the employee. What we said earlier, the employee is just a extended board member, but with the official corporate law organ responsibility. And there are manifold rules, partly in regular private law, partly in employment law, which is part of private law, rules in the Netherlands, in Germany, in all the 192 jurisdictions that protect the employee, that basically state, literally, the employer is liable. Comma, unless you mess up deliberately, majorly. So, if an employee of Shell in the Rotterdam area, whether or not intoxicated by alcohol, puts the whole plant on fire and puts in his diary, I hate Shell and I will ruin them tomorrow morning, first thing, and then that constitutes a criminal offense. And that is then the exclusion or the exemption of the limitation of their liabilities. But, ladies and gentlemen, even if such a employee is liable, what use is that for potential creditors, for the heirs of this drowned sailor, for the shareholders of Shell? Yeah? That employee earning 1/5 of your first salary might have a nice house to live in with a 110% mortgage, Okay, so we can auction his or her, it's most his who puts plants on fire, his color TV, and so maybe we get 20,000 euros out of this fellow compared to a damage of 1.5 million, 10 million, 100 million. And so the lower the liable potential person is, the irrelevant it is. Vice versa, board members tend to have assets. So there it is interesting to investigate potential personal liability. Because also a board member could make decisions. For instance, to not invest in electrical cars in BMW or Mercedes or Audi and leave that to Tesla. And then in 2030, gasoline cars are banned and everybody needs electrical cars. And so you could imagine decisions on board level that with a causal link cause terrible consequences for persons, financial consequences in this case. And then it might be interesting to chase such a board member. And the same applies to shareholders, because shareholders are quite often pension funds, Warren Buffett types, so Forbes 500 people, that might be interesting to make them personal liable, and that makes this sort of interesting. And then last but not least, skip the others, last but not least, there are two major types of corporate liability. And one is internally and the other is externally. Internally is that the board decides to raise all the salaries of all the employees with 400%. And you have financial feelings, so you know who is paying that. That is the investor owner, because then there's less dividend. So if you increase the costs in a calendar year, then at the end of the year there's less profit. And that could be an unlawful act in relationship to the shareholder. And then you could have a dispute between the shareholder and the board. That is internally. Or the maintenance guy putting the wrong metal ring somewhere in the plane or the vessel, then internally you could have a serious talk with that employee. Don't do that again. And then there are all kinds of company house rules that says, well, that cost you 120 euro. Those rules exist as a sort of internal punishment system to try to control your employees. In Holland we talk, let's talk. In all the other countries they punish. If you do it once more, you're out. And there are countries you're out immediately. Alright. And then externally are all those third parties. So the state who has to clean up the sea, the widows of the sailors who miss their income. If this is a lease company that is owning the vessel, then if it is broken in two, you cannot return it in good shape. That is then damage for the lease company, etc., etc., etc. Internally, externally. Well, and then, yes?
Can I ask a question? Because I know that in some big corporations, board members or the biggest employees get paid also through shares of their same company. But in corporate law, what if there was a board member, for example, is he seen as an extra vote or is it just a board member?
Yeah. The question is, what if the board member is also shareholder, investor owner? In the simplistic one-man corporations, that is always the case. So then the founder, establisher, is appointing him or herself as the manager. And as we discussed last week, the same applies here, that it depends in which capacity you act. So you are both. If you have shares and you're a board member, you're both. And then the assessment is done on the basis of in which capacity did you act. And how do you determine that? Well, based on the letterhead. So that is why secretaries are the most important people in your company, because they put the correct letterhead and Chamber of Commerce number in the printer, which produces the order or the decision that is done by you.
You could be liable twice.
And then you could liable twice. Yes. Yeah.
Yeah, that's also my point. So you're more liable as investor, owner, shareholder than a normal corporate board member.
Yeah. No, the basic rule is that shareholders are not liable in all jurisdictions because they do not have even dirty hands. So the only unlawful act is that they could trick with the shares or in relationship to minority shareholders do terrible decision making things. But those are restricted to financial damages.
Yeah, that was clear, but I meant in the sense that there's that one person company or owner board relation, as he just mentioned.
Yes.
You become more liable than actually your plan you set out to be.
Oh yes, yeah. Well, the moment you become a board member, then you have this dirty hands, especially with external liability, and that increases your liability indeed. Yeah. Well, and then the key phrase in most jurisdictions is that the non-liability is overruled if there is a situation of acting not in accordance with law conducting management. And that is a fascinating thing all over the globe, that you have a normal manager, a fictitious person that runs a corporation. And if your personal acts and decisions are in line with such a normal manager, that is then in accordance with normal management. If you step outside such conduct, then it is called mismanagement. And that is obviously extremely vague. And you could say that whatever courses you collect in your degree, that accumulates amounts to normal management. And if in your future career or your colleagues are making decisions where you get this feeling in 10 years, well, according to this and this accounting course, this is not correct, and then mismanagement happens. Well, and that is obviously extremely difficult to ascertain, and that means that in effect, normally managers are not liable and shareholders are even less liable. I mentioned a few acts where that is explicitly stated. Secondly, now that nobody reads civil codes or corporate acts or all kinds of other legislative instruments, these non-liabilities are translated to the Articles of Incorporation or the Charter. So next to the A4 with the stamp of the government, you exist as legal person, the corporation creates house rules, Articles of Incorporation, and then you see, and you will probably see, that's one of the tasks of your midterm assessment, where in the Articles of Incorporation is the non-liability of the managers slash board articulated, regulated. Well, and this is a example of ExxonMobil. Where it says, no director shall be personally liable to the corporation or its shareholders for damages for breach of any duty owed to the corporation or its shareholders. So, one step further in the limited liability sphere is that contractually you can even reduce the liability. And that is done in these types of Articles of Incorporation. So what we discussed so far was the legal obligation, so by law, unlawful act, damage, causal link, attribution, damages. And then, to be sure, as a manager, you can even try to reduce it even. That means that if a third party establishes in a court of law that the person, the individual board member is liable because of, you know, sexual harassment or all kinds of other wrongful acts on the workplace or wrecking a ship, that then that individual still does not have to pay the damages because of the contractual clause or the Articles of Incorporation clause applicable to all the board members, that they are not liable. So this is the plus package to facilitate the managers, half of you, to have an incentive to become a board member of a corporation. So these are then the deliberations and the considerations that are crucial for limited liability. Then we move to the transfer of shares. And transfer of shares is the last concept of the 5 basic aspects of corporate law. And then it starts with the investor owner who owns shares. And then the first step in the concept of transferability of shares is to see those shares as an asset, as if it is a chair or a table. And transferability of shares is nothing more that you sell the chair. And this also applies if you have a whole tree of corporations, as we discussed last week. Another word, very relevant, and you all know this because this is part of probably other courses as well, is the word acquisition. So acquisition is the word where a purchaser, a buyer, purchase or acquires shares of a seller. So the previous owners hands over the shares to another person. Similarly, linguistically, disposal means then that as a seller you dispose of your shares. And then the functional approach, the functional reason that we emphasize this whole phenomena is partly the continuity. The continuity of what? Of the legal person. And that in a economy is a fruitful, helpful arrangement in the sense that the existence of the legal person does not depend on the founder. So even if the founder is dead or not interested in that company, that products and services anymore, then someone else who might be interested can continue the other thing with the dispersed shareholdership, so in most countries that there is no dominant shareholder, the last function is that transferability of shares is just a allocation mechanism of capital, surplus cash, and a sort of tradable product, so that the share as such is a product with which you can trade. So there's no mental interest from the shareholder owner in the corporation as such, but only in the share as a valuable. And that leads to quite a few of the problems we discuss later on around mergers and agency problems, because if the shareholder owner doesn't look at continuity but at the share as a object itself of value, and then all kinds of topics like decision rights and so forth are empty concepts, because they're not showing up at gatherings where decisions are made. They cannot understand the extent of decisions, and etc. And so that is also part of the concept we discuss right now. Well, what is the transfer of shares? That is basically a sale and purchase transaction. So that is very basic private law, as discussed with colleague Michael Milo. That is offer and acceptance, the meeting of the minds, and then you have to agree on two essentials: which share, what price. And that simplistic mechanism can be done, I mentioned that in the introductory lecture number 1, can be done with light speed in a computer, 1000 times per second on trading platforms. But from a legal perspective, here we discuss an extremely simple transaction from a legal perspective, as if you purchase a croissant in a bakery store. Nothing more. Well, and then we move slowly to the merger topic. And then an example is Standard Oil, 1870, founded by Mr. Rockefeller. The last living grandson died last week of this Rockefeller, and he established the biggest oil company in the United States. Then we had competition law 100 years ago, that the misuse of a monopoly, a dominant position, was of concern of the federal authorities of the United States of America, and they forced Standard Oil to split up in 33 corporations, including Esso, Exxon, Chevron, Mobil, and all kinds of other corporations. As a side note, that was a sort of partitioning, so you cut the original one corporation in 33 corporations, and then you have 33 corporations. And that involves sale and purchase of shares. And we will discuss the technical. And then 100 years later, part of those newly founded subsidiaries are then merging again, as an example how even in our ordinary life we know of examples that are involved in this transferability of shares, and more specifically around mergers. What I suggest we do is that we, on this note, embark on a 13-minute fresh air break, and then continue with chapter 7 that zooms in on that merger topic. See you in 30 minutes. Thank you.